Hello guys, this is Hustle Hub, and today we're going to take a look at the free cash flow analysis of Nvidia. This is one of the stocks that you asked us. So let's head over into the spreadsheet. But before we get started, I want to thank WeeklyFinance, the YouTube channel, for putting down this model. And I recommend you to follow her because she shares very insightful financial knowledge. So make sure to check that out. I linked her video about how to structure a free cash flow analysis in the description, by the way. So let's start to compose this model. First of all, we're going to put the beta of Nvidia compared to the S&P 500. If you don't know, the beta tells us a bit more about the swings of the stock and the volatility. A beta of 1.37 means that on average, whenever the S&P 500 goes up 1%, on average Nvidia goes up 1.37%, and on the other side, when the S&P 500 goes down 1%, on average we'll see Nvidia go down 1.37%. The average return for the S&P 500 in the last few years has been 15%. Today, I did all the calculations necessary for calculating the weighted average cost of capital by myself on paper. So I'll just report the weighted average cost of capital without calculating all the numbers that you can see calculated on the video of WeeklyFinance. I'll just tell you that by my calculations, the weighted average cost of capital of Nvidia is 10.9%. Next, we're going to select the return on equity. Okay, let's head over to the return on equity. In the last 4 years, the return on equity has been on average 38.46%, and the dividend payout ratio right now is 9.28%. This is different from the dividend yield. This is the dividend payout on the total equity. I'll tell you that the dividend payout ratio is different from the dividend yield because the dividend yield is calculated based on the market cap, and the dividend payout ratio is calculated on the total equity. So the dividend payout ratio is 9.8%. Here it is. Here we have an expectation for the next few years. This is the growth rate that will happen in the next few years if the company continues to grow on this pace. I know that Nvidia has a lot of growth potential, not only for the gaming industry, but probably we'll see the automotive industry need for more GPUs and all the products manufactured by Nvidia. Let's suppose that in a period from 6 to 15 years from now, the company is going to grow its equity 10% per year, which is pretty high, but the sector of Nvidia is on a pretty solid growth base. So let's see what happens. Let's say that the perpetual growth is what we think that the company can continue to grow for years to come, even after the 15 years range, let's say 3% in order to stay a bit conservative. The free cash flow is correct. It is $3.22 billion at the moment. So let's put the enterprise value. It's 367 billion.95. Okay, so we see that by having this growth, this kind of growth, the degree of undervaluation would be very little, and as a matter of fact, I think that the company is a bit overvalued at the moment. Of course, we wouldn't have a margin of safety big enough, of course. You can decide for yourself what you think is a conservative margin of safety. I want to stay safe, so I prefer putting a high margin of safety, because we have to remember that, of course, Nvidia has a lot of competition. Other producers like AMD will be a tough challenge for Nvidia in the future. So, but if we think that in the range between 6 and 15 years from now, the company could grow even more than 10% per year, it could become reasonable. Here I've put 14%, which I think is pretty high. It would change our perspective. This is probably a bit too much to ask from. It's a bit too much to ask for Nvidia to grow 14% per year for 9 years straight on average. So if we put, let's say, 12%, it would still be reasonable, but I think that in this case I would rather wait for a possible drop in the stock before I buy, because in order to justify these prices, the company would have to grow at stellar returns over many years to come, and right now it doesn't make sense. I think it doesn't make sense from my point of view to invest and expect good returns over a long period of time. Of course, I cannot predict what is going to happen in the next few weeks or months, but I still think that Nvidia is a bit overvalued at the moment. So here's another example to prove what I was saying before. Let's say that the company grows in the range between 1 and 5 years at 20%, which is still a great return. If we take a look at the model by discounting a growth of 20% per year in the range between 1 and 5 years, we see that there would be no degree of undervaluation. As a matter of fact, the intrinsic value would be less than the enterprise value at the moment. So in order to justify these prices, these multiples, the company would have to grow at around 30% per year. Let's stay a bit more conservative, let's say 28, and the degree of undervaluation would be very, very little. And I want to remember that we're still considering the growth rate between 6 and 5 and 15 years from now to be at 12% on average each year, which is quite big. It's still quite big, and we wouldn't have enough undervaluation to see value in the stock. So if you think that that Nvidia can grow at a pace similar to the last few years, it would still be undervalued. But if the growth slows even just a bit, it would be hard to find value in this stock. This is it for the Nvidia free cash flow analysis. Of course, make sure to tell us which company you want us to analyze next, and comment down below. Make sure to subscribe to the channel. Go check out the WeeklyFinance channel, and see you the next time. This is Hustle Hub.